Hey everyone, welcome to the Investor's Guide to Joy. My name is Paul Graham, and I want to talk about our episode with Steve here for how it is possible to leverage your time and money because market value fuels the ego and income fuels the yacht. It's an awesome episode where we talk through a number of different ideas and differences from my experience doing private placements, his experience in stocks, as well as just his upbringing and his experience through his career, which are fascinating opportunities to really see how to uncover the best version of yourself. So enjoy. All right, hey everyone, welcome back to the Investor's Guide to Joy. So I have Steve here. We've been able to have a great conversation and just have different perspectives on how he's lived his life, and he continues to help others live theirs, whether they be close to retirement or really just investing for the long haul. So Steve, thanks so much for joining, and excited to get to talk to you more today.
Okay, Paul. Good. It was good talking to you already. I'm sure we'll get into it deeper now.
We'll get in deeper. Yeah. So had a chance to kind of review, your book and some of the things online. I mean, start chronologically, right? So getting into investing early. I mean, certainly everyone, talks about that to say it's always better to, invest today and save for, kind of the dollar tomorrow and things like that. What did you find from, kind of when you started at, 25 or maybe kind of earlier as things have progressed on? Have there been just like key takeaways that, young individuals, whatever that might be defined as, should really have in terms of like, actionable things? I really found, at least for my, self personally, it was just having an understanding of the life I wanted to retire with kind of today and making some of those challenging decisions to, I saved like 40% of my salaries, right? So 40% gross, right? Which is very aggressive by all means. But yeah, but so that helped me, right? And my mindset was, hey, I only need these things, these, shoes or other things or whatever people spend their money on. I didn't necessarily like need. So there was like extreme budgeting and there was an intention for a short amount of time to really accelerate that. But how have you kind of seen different people show up in that aspect? Is it really just saving a little bit along the way? Is it like accelerate saving that they would then invest, like, getting a higher paid job? Like what have you maybe done and then
I've
also seen?
I've been, I started investing on my own when I was about 25. Before that, when I was really a kid, and doing those summer jobs, like,
Sure, yeah.
and mowing lawns, teaching people how to water ski, stuff like that.
Cool. Okay. Yeah.
And my dad actually was a real estate developer and
Okay.
had a, and my parents had a very good quality, high quality life. I mean, and I was very fortunate because I could put away
Sure.
pretty much everything I made. In fact, he told me 25% comes to me. And he and his attorney actually did the investing.
Okay.
And long story short, when I was 25, at my celebration party, they dumped on me about 55 different stock certificates. You've never seen a stock certificate probably, but in the old days, there were
Yeah,
actually
sure.
certificates that you would get. And if a stock split, they'd send you another certificate for those shares in the mail, so you actually own the certificates for everything, or you could get your broker to hold them for you. And then they became, it wasn't, I don't even think it was electronic as much as it was a ledger of knowing that the shares were in their
Sure.
vaults somewhere. But that's
Yeah.
how long ago this was. So I had a very lucky start, and I was able to put away a lot of money from my investments. And I learned about the stock market immediately. Today's investors start off with 401ks and investments like that, mutual
Yep.
funds. So I would say that many of them don't even know that they own shares of individual companies, and what the difference is between an equity investment and a bond investment or a preferred stock. They're just not as
Sure.
into this, and they sure don't teach it in school.
Mm.
So I was
Yeah.
lucky. My parents were in the financial area, real estate. He had all the
Hmm.
stuff we talked about. He had the rental properties, he had the raw land,
Yeah.
he had a vertically integrated business. He would sell the insurance to the people that built homes. He would, insure them. He would loan them the money and hold the mortgages. So he owned a lumber yard for God's sakes. So he really had a vertical integration with all kinds of cash flow, funnels of cash from 4 or 5 different directions. And that's what he said and that's what he taught me really. is get income from everything you do. And that's what I did. I had all
Okay.
those stocks, I had the dividends coming in, and then I studied the patterns, the volatility, the market cycle, and figured out that if I buy IBM today at this
Mhm.
price, it's been 50% higher. If it should go up again because it always has gone up and down like that. And I
Sure.
decide, okay, I'm going to, as soon as it gets to be a profit of 10%, I'm going to take it and I'll find something else to do the same thing with. And I had a lot of them to work with. And, within less than 10 years, I was just below seven figures. And that's 1979. That was a lot of money in 1979.
Yeah.
And I wasn't going to do anything that speculative to lose any of it. And
Hmm.
I had grown the income to the point where I could stop commuting on the bus to New York City
Okay.
every
Yeah.
day.
That's a big
And,
change.
we built a house and I started investing other people's money for them. So that's my story. But I think the focal point of it is on the way there. It was all a function of income and the ability to keep reinvesting what you were making. At the
Hmm.
beginning, it was because I happened to pick my parents well and I didn't have to do a lot of my own financing of my education or anything like that. I could
Certainly,
put it
certainly.
away, you know?
Yeah.
But for anyone starting out, the same objective to get yourself independent is you got to put that money away and you got to invest it wisely. And in order to invest it wisely, you have to learn how to minimize your risk.
Yeah, certainly.
And that's where my book comes in because that's what it's about. It's half about minimizing risk and
Hmm.
another half about operating a portfolio for maximum income.
Do you think it's truly 50-50, or, what kind of percent would you think of income versus risk? Or does it depend on maybe the person,
I think
situation, right? Like risk tolerance?
risk is something you have to make an objective decision about at the onset. What are my requirements for a stock? What are your requirements for a piece of property? For
Hmm.
me, if I'm going to buy an individual stock, I want one that's profitable. I want a company that's profitable. I want a company that respects the fact that I own a piece of the action and I want a dividend.
Yeah,
I'm not going to give you my money if you don't give me a dividend.
certainly.
So those types of things. I don't particularly want you to be a one show pony. I want you to
Hmm.
have different operations. In other words, I
Hmm.
want you to be a big, solid company, stuff
Yeah,
like that.
sure.
So those are tests of quality. I want you to have a low PE, low price earnings ratio.
Yep. Yeah,
And I want
certainly.
you to have a relatively low debt to equity ratio too. So when I was doing individual stocks, that's the way I would pull the ones. And in those days, I was saying I don't want to buy anything over $80 a share either. That's just crazy.
Yeah.
I'm talking
Times have
back in the 70s,
changed.
80s, things have changed.
Sure. I hear you.
Yeah. So, and there also was an S&P guide at that time. Standard and Poor's had a guide that as a subscription,
Yeah.
you'd get one every month, and
Sure.
it listed all the stocks, Nasdaq, there was an American change exchange at one time too, Nasdaq, S&P, Dow, all the stocks, and they rated them. They rated them from D through A plus, and anything B plus or better was what they called investment grade.
Yeah.
So when I started investing for other people and myself, I required B plus or better. They
Hmm.
had to be investment grade, they had to be dividend paying, they had to be traded on the New York Stock Exchange because at that time the New York Stock Exchange had stricter rules than the NASDAQ or the others.
Hmm.
So really, I try to make things as safe as possible for my clients and for myself too. So that's
Yeah.
quality, and quality comes first. The fact that it pays a dividend is a sign of the quality that it's got enough cash flow to do that. If you bought in those days, if you bought, oh my God, a NASDAQ company, that's where the original techs were going, and the fatality rate on the NASDAQ in the early days was, pretty high. I mean, you were getting there, your penny stocks were there, you're really all your newbies were there. And truth be told, there aren't a whole lot of Googles and Amazons,
Sure.
compared to the number that they ring the bell on at the end of the day when these guys, have their IPO. The success rate of IPOs is not all that spectacular, so
Yeah.
you'd stay away from that kind of stuff.
I've invested
So
in a couple, but that's just been for more fun and to say I
yeah,
did.
yeah. So
Um,
quality is always job one. And
sure.
income generation is a piece of that.
Yeah, certainly. One thing that stood out to me in your story is something that I relate to because I had that same experience, and that was driving, commuted like an hour and a half outside of, college jobs to get that sort of job, but still have that, rent or just, where I was at, right? So I had a lot of time in the car, right? You had a lot of time on a bus. For me, I was listening to, Bigger Pockets or having mentor calls or calling people or maybe just
Uh-huh.
staring at the car in front of me because it was a long day. That really helped me set up for executing and doing some of these things that I had that dedicated time, right?
Yeah.
So for you on the bus as you were going into the city and you were able to build, that, wealth and really this knowledge that you executed on over that span of that 9 years, what were you doing, during that time? And were those things helping you with that? Or maybe you were just taking a break,
Well,
but just curious in those little moments.
well, for one thing, we didn't have cell phones then, remember?
Sure. I'm thinking books. You got books
I
and
know.
newspapers,
I
right?
did. I did. I got my
There
master's
you
degree.
go.
I got my master's degree while I was commuting to New York,
Cool.
and
Awesome.
my employer paid for it. So even though I didn't like the job very much, or the employer, they did pay for my master's degree. So I would do all my studying on the way in and the way back from the city.
Okay.
So, but
Yeah.
that's what I did. If I wasn't doing that, I was sleeping because
Okay.
I had to get on that bus before 7 o'clock in the morning, and then I'd walk up from the Port Authority building, and it wasn't a pleasant walk in those days in New York City, in
Sure.
Manhattan,
Yeah.
up until the 50s. My office was on 51st Street.
Okay.
So it was a good walk. At least I was getting my exercise. But
Yeah, sure. Your steps in, as they say.
yeah.
One thing we chance to talk about was, your, success, right? Of what you initially did, and then also certainly what you're, doing today to help other individuals and kind of coaching them and training them for the concept of celebrating and celebrating, wins and whatnot. You mentioned something before we, started recording of just like we've been celebrating for, so many years, right? When you initially sold that company, it was like, hey, how'd you celebrate? It was like, oh, we've been celebrating for so many years. And that's not something that I personally have heard because I ask this question basically to
Yeah.
everyone anytime they say anything like, oh, I passed this class or this test or something like that. Like, I just think it's absolutely vital to celebrate like the small wins for the affirmation, for just the joy of, the smallest things. How did you get into that like mindset and start taking action on it? Because I'd be fearful of my former self where it's like, well, I can't, afford it, or I want to go to that trip to Italy because I passed this like one test and they don't like relate, So curious how you've,
I
tied that in.
Well, in the initial years, the first we were married. We've been married for from nine since 1970. So that's
Okay. Yeah.
that many years.
Sure.
And how we sell, I got this business going, and we started to make some significant dollars. And then we would take a we say let's take a cruise. Let's in the winter, let's go on a cruise, or we bought some one way we celebrated is my buddy and I went out and we bought a condo out in Colorado, and we
Awesome.
to go skiing, and we owned
Cool.
it for 15 years, and we'd celebrate by going there 3 times a winter. So your levels of celebration may be less as when you're younger, but then when you start managing $100 million, and my cut of the fees was average about 0.6%, 0.5
Mhm.
percent. That's a good chunk of change to
Sure.
put away. And my emphasis was making money with the investment. So I was averaging, let's say, 8% on that money a year.
Mhm.
So, between the salary and the amount I was accumulating in my investment portfolios, if Sandy said, "Hey, I really want to go on this trip to Australia and New Zealand," it's 3 weeks, and she, like I told you before, she doesn't
Yeah.
know what the back of a plane looks like. You'd spend some significant bucks on doing something like that. But what that was celebrating was not necessarily a specific event, but our ability to create this lifestyle that let us do that without either depleting our holdings,
Yeah, certainly.
but from just, okay, I need to get that money ready by 3 months in advance. So by just putting it away from the income stream. So
Mhm.
yeah, that's the kind of celebrating. It went from the simple little things as you get older and older, and then all of a sudden you get in your 60s, and I'm in my 80th year, put it that way. So you
Yeah,
get here and geez, my dad died at 89. My mother lived quite a bit longer, but hey, who knows what can happen. So we've
certainly.
got we've got all this. Our kids are doing fine. We're going to do whatever the hell we want,
Yeah,
without being
definitely.
stupid. I mean, I'm not going to buy a Ferrari.
You can rent one though. You can
I
totally rent
probably
one.
will. I don't trust myself to drive that much. Just like I don't ski anymore because I know I'd hurt myself.
Sure.
So you learn that as you age, but you don't stop the celebrating, and we haven't stopped the activity. Like, we don't
Yeah.
go on sea cruises. We go on river cruises and land tours because we
Hmm.
want to go walk up there to that castle and see what that was really like. You know,
Cool. Yeah.
we want to experience. As long as we can do that, we'll continue to travel the world. So
Yeah.
it's
It
just a
reminds me
matter of
of
how it gets to be. Your health and your wealth dictate what you can do to celebrate your life.
Yeah, no, it's a good tie-in point of, yeah, just like living an active life. And it's something I've seen,
Yeah.
within my parents, right? They're in their early 70s, and their ability to went to like Alaska and like went on a helicopter and,
Yeah, I've
traveled
done that.
a little bit. Mom, she got a new hip. So, that limits, some things, but still keeping those active type celebrations, I think is a really good point to just reiterate, not just the celebration for the sake of celebration, right? The, alcohol by the, pool with the nice room, right, is a very different experience and intention than, like you mentioned, of hiking and seeing what it was really truly like. And also that different experience of history too, in that case, not just, again, another pool or, hotel room,
Yeah,
is,
exactly. There's so
yeah.
much. The world is so great. I mean, there's so
Yeah.
many.
And yeah, your ability to experience it, and then, to your point as well, just, help people with their investments and the investors themselves. You mentioned creating, a lifestyle. Were these things that you envisioned, right? So I'm familiar with vivid vision, right? I have my 3-year vision, things like that. Like, was that an intention set before, or did it kind of happen and then you looked and were like, well, yeah, let's, go on this
when
trip or things like that? Like,
when
how intentional about it?
well, when that pile of stock certificates landed on my table at age 25, and I had the responsibility for that, and I saw the amount of income it was generating and
Hmm.
how I could really make that almost double that income by trading regularly.
Hmm.
Yeah, I put together some goals. I wanted to stop. I wanted to get out of New York City. I wanted to say farewell to that company, and I did that. And I wanted to start my own business, and I wanted to help other people do that. But I also wanted to I wanted to make a lot of money. I
Sure.
did. I had some objectives of what I wanted to
Yeah.
have in my portfolio at a certain point in time, and I achieved most of those objectives. And I shared that with a lot of people. And so I felt like I was doing things. And we had some family people I've been able to help a little bit on the way too, so it's been fulfilling and
Yeah.
in every way. And and like in the coaching business, and I looked to see what people were asking. If you went online for a financial coach, you see some big numbers they charge.
Hmm.
And I don't know what they do for that, but I just wasn't going to do that. I wanted to touch people and get to know them, and it was just different with me. I didn't I don't I can't spend it.
Yeah.
I'm not going to throw it away, but I am going to enjoy it. I
Sure.
have plenty to enjoy as long as my health holds up. So
Yeah.
I don't need to have another job that generates the kind of money my old job did. I just need to have
Yeah.
fun. I just need to have fun.
There you go. Just
And
need
like
to
I
have
have,
fun.
I have fun talking on a podcast like this.
Yeah. Yeah.
It's fun.
Yeah. I've
So
really found, like, finding the things that you have joy with, right? And that comes with just trying, understanding, learn, and then just do those things. Like, you can't not have joy by doing things that bring you joy. So totally relate to you talking about, water skiing, or just skiing in, general. I love everything on the water, right? In water, around water,
mm,
on water. I like drinking water. So yeah.
speaking of that,
One thing that came up, I was curious as you were talking about, was sharing it with people. So were you referencing that you were sharing like your goals with people?
I was helping people attain their goals.
Okay, okay.
But I wasn't so much sharing it with them while I was still running the business, I was, of course, they knew what I was doing and I was reporting to them and I was writing articles that explained all the things that and then I wrote two books that told the world exactly how to do this, what I do. So yeah, if that's sharing it as well. But there was some actual hands-on sharing and helping people get through tough times or
Sure.
providing them with an opportunity to get where they wanted to be,
Yeah.
and I made sure my kids had all the educational and my grandkids now.
Yeah,
My
certainly.
granddaughter's graduating from college next. My youngest is graduating from college next year.
That's incredible.
So
What have you found for, your why? Like has that changed over time? Like what's the why that has driven you or maybe continues to drive you?
I think it's genetic.
Okay. How so?
My father worked until the day he died, in
Sure.
the real estate business. He just couldn't stop it. My wife can't believe my calendar is fuller than it was when I was managing money for people because I didn't have a lot of one-on-one conversations. It wasn't like they called me up and say, "Hey, Steve, I want to do this."
Yeah.
I was running the show. And I told them I sent out a letter about every month or 6 weeks saying how I felt the market was behaving and whether it was
Hmm.
giving us a particular opportunity and what they could do to take advantage of an opportunity if I thought they had, if you have any
Sure.
spare change, the market has just crashed. This is when we buy,
Hmm.
So giving them the suggestions. I didn't get a whole lot of calls because I kept them very well informed about what we were doing.
Hmm.
And I grew their income every month, every quarter.
Sure.
And
Yeah.
they saw that. They could see that because I made that. I taught them, look at your income, look at your growth in capital. Think of growth in capital as opposed to growth in market value. Are you long you know what my distinction is with that? What I mean by
No, I would say describe it. Yeah.
working capital. Let's say you invested a bunch of money in a bunch of buildings, right?
Hmm.
And the amount you invested, that's your working capital. That's the capital you've invested in this enterprise. Now, the market value of your office building or your rental property may go up and down with whatever's going on in the real estate market, right? But
Hmm.
you're in there because you have that income coming in, that rental income, either from the people who are renting the office space or the apartments or whatever it is. And
Sure.
that's where you're making your money. That's the cash flow. You're not planning on selling this. But if somebody came in and wanted to buy it, or if the market changed it so much that you wanted to make your apartments individual purchasable entities, you know, and you got the right price, you'd be willing to sell them at a profit, to generate the income. And that's where the working capital grows. Working capital grows by the income that you put into more apartments or renovations or whatever. That increases your capital base, more
Hmm.
units. When you sell one, the profit becomes part of the capital you have available to invest. Same with the stock market. Okay, if you have a start off with $100,000 portfolio and the market goes gangbusters and it gets up to 140,000, you still only have 100,000 of working capital, just what you started with. The income coming from that original 100 is still the same. It hasn't grown just because the market value has. Nothing really has changed except the market value. So
Yeah.
then you go and you sell that, and you take that $40,000 profit and you reinvest it. Now you got 140,000 in working capital. It's generating 40% more income than your 100,000 was. So you've gained the benefit of that increase in working capital. Okay.
Yeah.
And even if the value goes down to 110,000, you still have 140,000 invested, generating that same amount of income. So that's the difference between market value and working capital. Working capital is the amount you've invested in talking about portfolios, the amount you've invested in the securities you own, plus any available cash you have. And available cash is cash over and above any reserves you're holding for expenses. Like, for example, I hold $25,000 in my portfolio for contingency expenses during the month,
Sure.
and I don't invest it. So everybody should have that, should have something. And that's one of the fallacies of professional management today. All of these accounts are set up to reinvest income as soon as it comes due. You put it on drip, you set it and forget it. The income comes in, it's immediately reinvested in the same companies so that if you ever have an emergency and you haven't set anything aside, you have to sell something in order to get that 25,000 or whatever it is that you have to spend. So it doesn't allow you the flexibility to prepare for your future in the current environment for most managed portfolios.
Is there a general rule of thumb to say, hey, don't reinvest dividends automatically and keep it in a pool and then evaluate and
Yeah,
then
that's my rule.
okay.
I have a whole chapter in the book. It says, do not
Okay.
do not drip
There you
dividend
go. Okay.
reinvestment program. No, because you want to selectively make investments. You want to think about it. If you've got even illustrate, if Microsoft is at an all-time high and IBM is down 40% from its high, you don't want to add to Microsoft. You want to add to IBM because it's at a lower, weaker price. In the closed-end fund field, if you have right now, perfect example right now, you've got the stock market is almost at an all-time high, right?
Hmm.
It's just been there. It's been there 25 different times this year already. So
Sure.
stocks are up. So right now, if you got an opportunity to take a profit on one of your closed-end equity funds, your fixed income part of your asset allocation, your income bucket has fallen in price because from 2022 on, interest rates have gone from 0 to 5%. So when interest rates go up, as you know, with mortgages, it's exactly the same way. If interest rates go up, the value of the security goes down so that buyers will get that rate. That's what that's right now the prices on income securities, bonds, preferred stocks, and so on
Mhm.
are up from where they were a year ago, but they're significantly down from where they were 4 or 5 years ago when interest rates were so low. So it's a perfect opportunity if you're close to retirement, let's say, and you got all this money invested in the stock market, and now you're really feeling good about your
Yeah.
market value. Man, I am so rich. Take some profits and increase your income now while interest rates are still very high. I mean, you could take profits on something and reinvest it in an equity portfolio of closed-end funds and get 9% income on it. The same and more than 10% in the fixed income portfolios. So, it's that type of thing. So, working capital and market cycle are two things we just discussed. And there are
Yeah.
also two things that I really go into in depth in the book of
Awesome.
working within what the market gives you. You can't do anything about it and you can't predict it, but you can prepare for it. And
Certainly. Yeah.
there's a
Magic
big
eight
distinction.
ball doesn't work, or at least I've not
No,
seen that.
no,
That
no,
does.
no. Not even
What
any of those talk show guys can on
not
TV.
even the top
Not
guys, yeah.
even those guys know what's going to go on tomorrow.
Yeah. What have you heard of an organization called Faith Driven Investor out of curiosity?
I think I've maybe
In passing or something? Yeah.
read it
Uh,
somewhere in passing. Does that
sure,
mean
sure.
faith like religious faith?
Yeah, so there's been a fascinating thought that's, come kind of in my neck of the woods recently where it's to say there's like return on, investment, right? We've talked a lot about that, right? There's also like socioeconomic, like impact type investing, and
Right.
there's also like eternal type investing, right? And
Eternal.
so yeah, so there's been like I'm trying to summate this where the types of companies that you would invest in, like being a fund manager, would be related to organizations that have some sort of maybe faith-based mission or like parallel nature to it, but also have like, good investments as well. And so, my curiosity was one, if you heard of it, but then it's also to say, as you invest or coach others to invest, are there other things you're thinking about than just the returns, just the cost, just the, this or that for, those
It's
things, or even just like exponentially, right? Personal thought is just like, hey, let's invest in space because, we're eventually going to get to Mars and the returns are going to be out of this world, pun intended. That's an
right.
asterisk, right? But that's also a risk if you have that belief and there's that opportunity like fallacy that I believe a lot of the stock market has because you have the Ubers and Lyfts and all these software companies that are running at a loss. Yet it's like, no, this company's going to be profitable, right? So longer tangent is say, like, are there other asterisk things that you may consider with, evaluating some investments? Because I've just seen too many individuals I know that are in maybe crypto or these other things. And not to say it's inherently bad, but it's just those asterisks are then by definition, risks, if you will. So just curious from your perspective on that.
I avoid risk and minimize risk as much as I can. And
Certainly.
I
Okay.
talked about the quality and some of the things I apply to quality, and diversification is another one, and generating income and profit taking. But the first three, the quality and what you think of as quality, diversification, and income generation, the income generation eliminates most of the things you mentioned
Certainly.
because
Okay.
I don't do
Yep.
anything that doesn't pay income, you know.
Sure.
So
You don't do
R,
anything at all, like even like three to
I
five
wouldn't
percent of portfolio?
nothing, zero. If it
Okay.
doesn't pay income, I'm not doing it.
Sure.
It's just one of my requirements, and it works for me. It
Yeah,
works
certainly.
for my
And it
my
also works, right? Like things that work, work. So yeah.
exactly. There are closed-end funds now, just recent additions, and within the 5 years, because I only buy them if they've been around for 5 years. But we now have ones that are in, the AI. We have
Yeah,
them.
sure.
We have others that are in impact, environmental and social impact funds that
Hmm.
they select companies that they feel, I guess, are good with the entire environment, and they own more than 50 companies within them, so they're okay with me, so they're diversified enough that I will use them in my portfolios. Because what I use in my portfolio is what I tell my what I used to tell my clients. I'd never own anything for them that I don't own myself, right? And I
Certainly.
used to I tell that to my coaching clients too. What I'm giving you as suggestions for you to research are things that
Yeah,
I own. I'm not looking for you to research something that I don't own. And if you don't feel I'm right, fine, don't do anything with it. But
sure.
know that I own it. And if that gives you any confidence, fine.
Yeah,
So that's the type of thing. So yeah, I own some of the AI, I own some of the impact ones in that thing because they meet all my requirements. They pay a
yeah.
significant amount of money in dividends. They've been around long enough. They have more than 50 issues inside. So I
Hmm.
know that they're well diversified and so on. Yeah. Yeah, I go to places like that, but I know ETFs now have some that have crypto
Hmm.
ETFs, I think now, but I don't own any of those. And I won't because I don't own any. I have a special universe for people with high seven-figure in portfolios that I have this
Hmm.
other one that I use that has about 20 ETFs in it. And they're high income ETFs. Like and it's funny. Four of them own only CEFs within them,
Hmm.
so they're owning what I own otherwise. Some of them are like covered calls, it's not covered calls are not risky like naked calls and puts are because you're not doing anything you don't own. And if you know what you're doing, you never put out your call below your cost basis. So you're always making a profit if he gets called away, you know?
Yeah.
So those are really safe in a sense. For options, they're sure safe. And then a few that have preferred stocks in them. So I've got about 20 of those, but I won't even allow any of my clients to have that unless they have, portfolios of nearly $2 million. That's
Sure.
because I think they're more risky in that, if you're below that level, you shouldn't be taking, you don't need to take that kind of risk because there's
Hmm.
so much good stuff that you can make a lot of money on. You just
Sure.
don't need it. So no, I'm not that adventurous, and I've not seen any of the closed-end funds that I use ever in a faith-directed,
Okay.
and
Yeah, sure.
no pun intended, I'm really not a believer in that type of an investment. I don't think faith has anything to do with it.
Pun for pun.
But
One thing that was kind of like reference of sorts in the book high level is the concept of stop agonizing over market volatility, right? So I see this a lot within real estate because that's essentially my background is like, oh, well, I can't because of the rate and all this kind of stuff, right? So talk to me more about that. I mean, the word agonizing really came to mind because it tends to be just a mindset of like, well, not yet or not right now, or even like a
yeah,
self-worth thing of like, no, I shouldn't wait on that. I don't deserve, because it's almost to say you want the math class, right? You want the right answer and you don't want to be wrong with investing, but there is some risk in investing.
Well,
So what is that like mindset and
well,
actionable
well,
type piece like?
volatility, which is really a measure, they could use that as a measure of market risk. Volatility is the way the market value fluctuates, right? It's not really a risk. It's the very nature of things.
Certainly.
It's the
That's a
reality.
good thing to
It's the
point out. Yep.
reality of investments. So
Hmm.
one of my quality checks in closed-end funds is that sucker has to have volatility. And they usually have a much smaller trading range because they're a large portfolio of different securities. So they're not going to have as much of a range of price like an individual stock would. It's kind of compressed, you know. So in that trading range, they'll have a lot of up and down movement. And that's one of my requirements. I want that because I want to be able to trade that security frequently. I look at my portfolios like a department store, you know what I mean? So
Yeah.
I've got everything on my shelves. Any sector you want to talk about, any methodology that goes with investing, it's in those closed-end funds. And I set a target price on them. In the meantime, I know they're yielding on average right now, I'm about 10% on the taxable ones and almost 5.5% on the tax-free side. So I know how much they're making for me. And if I can make 1 or 2 months income by taking a profit, I'll take it
Hmm.
even if it's lower. You know, if I don't have anything that's at 5%, which is my maximum, believe it or
Hmm.
not, then I'll take something lower because I want to add to positions that are down in price and increase the yield, decrease the cost basis so I can get more profits sooner. So, I'm always working with it. And it really doesn't matter to me which one I sell because I
Hmm.
know I always have something to replace it with. And volatility is the engine that makes my profit taking take off. I run portfolios to have two streams of income. If the guy has a rich uncle or something like that, then there's three streams of income, but two streams of income. One is the distributions or dividends and interest that comes in, and the other one is the income from profit taking. When I was managing money for other people, I told them that I'm going to try to make you every year more money in capital gains than you pay me in fees. Okay. And so now what I do for myself, what I want to do, I want to try to make 4, 5, 6 months worth of income, additional income
Hmm.
from capital gains. So if I'm making 100,000, I want to make another 40 or 50,000 in profits. Okay.
Yeah.
So far this year, I'm at just about to hit the 3 month mark. So through the end of May, I'll be almost at three times my average monthly income
Okay.
from profits, in addition to the income. You see what
Yeah.
I'm saying?
Yeah.
So it's like a multiplier effect. If
Sure.
you're, you know the math. If you've got X amount of money, if you're getting 7.5% a year, you double your money in 10 years, right? If you're getting
Yep.
10% a year, you double it in 7.5 years. And then if you're making almost 10% on your money because interest rates are what they are right now, and you're making another 3 or 4 months worth of capital gains, then you're doubling your money in a short period of time. Meaning,
Yeah. The
maybe 5 years or something like
certainly,
that.
certainly, yeah. The rule
So
of seven definitely lives
so
on for sure.
that's what you're looking for. And when you're doing all that in a collection of funds that are as safe, I think even safer than mutual funds are. Because think about how mutual funds prices fluctuate or change in corrections and in rallies, right? The managers of a mutual fund have to buy more securities if people want to buy more short shares of the mutual fund. The only other thing they can do is they can close the fund, and some managers are good enough and smart enough to do that. They close the fund to new people because they know they're too high and they don't want to be buying share. They don't want to be buying stocks at that high. Okay.
Yeah.
So they, but for the most part, they must do what the mob wants them to do, the mob of buyers. In a correction, you want to sell your shares, they've got to sell shares. A closed-end fund manager doesn't have to because just like the stocks themselves, his
Hmm.
stock is not controlled by the mob. The manager makes the decision of buying or selling whatever inside the fund.
Yeah.
The shareholders are exchanging shares with one another. So if you're panicking and you're selling your shares in something that I
Yeah.
want, I'm getting the benefit of your fear, you see.
Yeah,
So
certainly.
that's
Yep.
that's that's the big distinction there.
Yeah, and the bigger picture too. Awesome.
Yeah.
So one thing, or I guess the thing that I always ask within this interview is, since it's the investor guide to joy, right? What would you want to leave in the guide, right? Is it a quote, a motto, an intention, life lesson, something that you would put and kind of stamp your name on?
I'd almost make it as simple as the quote we talked about before. If you can focus on income, if you can realize that the growth in markets, particularly in the environment we have now, where most managed money and most commentary and news is market value focused, you know,
Hmm.
if that one quote that we have on the cover of the book, that market value fuels the ego. If people think about that and they say, yeah, it is, my market value's gone up, but what has it really done for my future? Is it
Hmm.
generating more income? No, I have to sell that stuff to make it, put it in something that's generating income. So market value fuels the ego, income fuels the yacht, or you can say income fuels the car, if you wanted to.
Sure.
It doesn't have to be a yacht, but the principle is the same. Principle is the same. They've got to wrap their head around the idea that having income is what gives them the lifestyle they want. And you can do it. And if you do it this way over a long enough period of time, you can replace your business or your salary income using your portfolio.
Yeah, she's king. No, it's
Yeah.
incredible.
Yeah.
Steve, really appreciate your experience that you've shared, right? And knowledge within this as well, because this is again different than my area of the woods. I just have my stock portfolio in all transparency for reserve funds so I can buy more real estate. And then,
Okay.
certainly with the syndication. So it's not I'm against, it's just I lean in the opposite way. So it's great to have a different perspective. I'll include all the details, we shared, as well as a link, to your book. So I enjoyed reading, aspects of it. And thank you for, coming on today. Really do
Yeah.
appreciate it. And I think you shared some really good insights for people.
Yeah. I enjoyed the conversation, Paul. I think it
Incredible.
was a good one. Yeah. And it was different from a lot of the other podcasts I've been on too.
Good
Took me,
deal.
took me
Yeah.
places I haven't been. So
Well, there you go. Traveling, right? We're
there you
celebrating.
go. Exactly. Here.
Yeah, love it. Cool. All right. Well, thanks, Steve. Appreciate you coming on.
You're welcome. Thank you.
Thanks for joining the Investor's Guide to Joy today, where we aim to change your life by 1 degree in each episode. These days, I'm raising funds for oil and gas syndications, a luxury short-term rental super property syndication, which is a lot of fun, and managed by Luxury Desert Escapes. I also help people get what they want through finance, mindset, and action to help them eliminate worry, build better habits, create their life, and live their life. If any of these things seem of interest to you, or you just want to chat, connect with me. Let's chat more. Until we see you again.